Hello and welcome to Switzer Investing Insights. And with the end of reporting season looming, the big question is, can the index make 7,000 by year's end? Well, Paul, tough question. Can you answer it?
Well, I'm going to answer in a moment, Peter, but let's start with some data to look at how reporting season has gone. And these charts come courtesy of AMP Capital. The first one shows sort of beats versus misses. In other words, did the results come out better than the market expected? About 47% of companies beat expectations. That compares to a norm of about 44%. The beats are in blue. In terms of misses, that was also better in a relative sense. Only 22% of companies have missed on market expectations, and that was lower than normal. Let's look at profit growth. This next chart shows both profit growth in blue and also dividends in red. So 79% of companies reported a higher profit than the year before. That's better than usual, and you can see that if you look at, compared to the left-hand axes. The red line looks at companies increasing or maintaining dividends, about 86%. That's pretty normal, but we did see pretty good dividend growth. So overall, reporting season has gone pretty well.
It's a bit like the economy, Paul. It's been good without being great, and it does kind of make you feel optimistic about the future, but not excessively optimistic. So let's have a look at the themes.
Yeah, so let's translate that into some of the themes that have come out of reporting season. So first of all, earnings per share growth are up about 9%. The resources sector about 25%, and the rest of the market about 5%. When we went into reporting season, Peter, we were expecting about a 7% growth.
Yep,
so that's
right.
come in about 2% higher than expected. So that's a positive. The next theme, I think, and this is probably the biggest standout of reporting season, is the so-called growth companies. Have actually done pretty well. By growth companies, I mean those stocks trading on pretty high PEs. In other words, the market's put a premium on their price because they're actually delivering earnings per share earnings, or they're growing EBITDA and one day will be profitable.
I'm thinking AAA, Altium, Appen, Afterpay. There's probably another A in there as well.
There's probably lots of companies, both technology, but also look across sectors like some of the consumer-facing stocks like the Bellamy's and the A2 Milk. Blackmores have done well. Also look at things, say, in the healthcare sector, the CSLs, the ResMeds, the Cochlears. They also did well, and particularly the CSL results. So growth companies, companies pitched on a higher multiple have done pretty well. Consumer-facing companies, I think, Peter, have done well. Retail's done better than perhaps expected. Perhaps sort of suggesting the Australian economy is doing better. Maybe Amazon's yet to have that big impact.
Yeah, exactly right. And also, Paul, if you've been looking at the debit and credit card balances, particularly the credit card balances, they're actually starting to jump up. So that means consumers are getting back in the game.
The next theme for me, Peter, is resource companies. Look, they've largely met expectations. We talked about profit growth of 25%. So they delivered in terms of how the market was looking, but the clear take was they're really finding cost pressures going forward. So things like higher energy costs are starting to bite. They're facing higher labour costs as they start to reinvest and increase capital expenditure. So I think going forward, resource companies, the days of sort of being able to really increase productivity, take out costs, that's going to be a lot harder. It's now about actually just pure commodity prices in terms of driving profit growth.
And global demand.
And then finally, for me, the financial sector was a bit underwhelming. The Commonwealth Bank report wasn't too bad, but we had some of the other majors with quarterlies. We had some other companies like Challenger a bit underwhelming. So look, it's tough being a financial company with
the Royal Commission.
Royal Commission. No one wants to grow. Revenue growth is pretty limited. Can't be aggressive. And we mentioned the point about dividends. So I think they're the sort of themes that came out of reporting season.
Okay, so let's just wrap it up, Paul. The big takeaways for you for reporting season.
Well, obviously we had it's a positive. But I think the question where we started is it enough to get to 7,000?
Yeah, exactly.
I mean, compare the earnings per share growth in Australia of about 9% compared to about 24% in the US. That's why the US keeps making record highs, right? It's why our market is struggling. So I don't think there's enough in reporting season per se to get us to that 7,000, right?
No, exactly right. But I think the only thing that could help us at least approach 7,000, and I think a figure of 6,700 is a possibility, particularly if Trump can crack a deal with China. If we see the $200 billion tariffs imposed on China's goods, the market goes down. But if he comes up with a deal like he did with Mexico and possibly with Canada and of course the EU, then I think the market, in Wall Street in particular, will be so excited, it'll rocket up and we'll be dragged along.
So really, we're going to need offshore influences, Peter.
Yep.
You're absolutely right to drive us. The other thing I think that's just come into play in the last couple of weeks is really the heightened electoral risk.
Yeah.
That's potentially a negative. Now, we know the election could be as late as May 18 next year if Prime Minister Morrison's able to serve the term he wants to. But, we've got a by-election in Wentworth. We've got some nationals talking about whether they'll sit on the crossbenches or not. Yeah. An election this side of Christmas is still a possibility. So electoral risk generally, elections are normally bad for markets because markets don't like uncertainty. Yeah. So that's something to factor in. But look, I think with you, if it's all in President T's hands largely, that will be the big driver for us to get to 7,000. I don't think we saw enough in the market with reporting season for that company profits alone to drive this market. On
7,000, I would probably use the old Rachel Hunter line. It will happen, but it won't happen overnight because I think we do need some really good stuff happening overseas, like the Chinese Trump deal. If that doesn't happen, I think we'll be dragged up nicely. Probably 6,700 is more likely than 7,000. So that's Switzer Investing Insights, brought to you by NAB Trade. Thanks for joining us.